Good morning, ladies and gentlemen. I'd like to welcome you to the final session of Gold Standard University Live. Truly, the final session of Gold Standard University Live.
No more encores.
No more encores. If we clapped a lot, perhaps. We are going out on a high note. I mean, many times when things end, you have a sense of finality. And there's no sense of finality to this group here. I mean, we're in the very room that the professor started us in over 2 years ago, which is sort of nostalgic in its own way. And rather than a sense of finality, I would rather we see Gold Standard University Live as a birth, the initial birth of something that has given more seeds. And it's Philip's thing, and it includes all of us. Not just the organizations, but the individuals and what we carry from here and what we've learned, as a result of this. But without further ado, I, for one, have been looking forward to this lecture, this last lecture of this university, and I want to repeat the title because when I read it, it just intrigued me. His talk is going to be on the vaporization of the derivatives tower. Professor Antal Fekete.
Thank you very much. I will start by saying that the gold standard is misconceived by many, even my friends, who believe that the chief merit of the gold standard is the stabilization of prices. This is a mistake. Prices cannot be stabilized, and it's not possible, but it's not even desirable, because variation of prices is an indicator, it's a message from the consumer to the producer to adjust production to the level of demand. It's not the supply which is the leader, it's the demand. The supply is a follower. So there has to be a communication system. So it's a misconception to say that the gold standard is supposed to stabilize prices. But what the gold standard is supposed to stabilize, and it can, and historically it has done it very successfully, is the rate of interest. And the mirror image of the rate of interest is the bond price. I have explained it in earlier sessions of Gold Standard University that there is a very rigid relationship between the rate of interest on the one hand and the bond price on the other. And this is an inverse relationship. As the rate of interest rises, the bond price falls, and vice versa. This is very rigid. And this statement, this theorem is not controversial. Everybody accepts it. So when we say stabilize the rate of interest, that's exactly the same to say stabilize the bond price. And a lot of other things, like foreign exchange and whatever directly depends on the rate of interest will be stabilized. And flexibility will be imparted to other economic indicators as much as the state of economy requires. So the gold standard has done its duty when it stabilized the rate of interest, because the rest will be taken care of. So this is my starting point. And you will see, or you already see it if you look back to the history of the past 30 to 50 years, that this destabilization of the interest rate has done a great deal of damage to the world economy. It has disrupted production patterns, it has disrupted financial markets, it had indirect implication on the equity markets, and so on. It could continue indefinitely. The bond market, very few people are aware of that. The bond market is actually far more important than the equity markets, because a rough comparison shows that the order of magnitude of the bond market is about 10 times the size of the equity markets. So this is, and it's still growing. So when we say stabilization of interest, this has an enormous impact on the world economy. And without it, there are all kinds of dangers. Now, I'm not going to repeat what we have already said during this session and other sessions, that the debt is growing because I think we have said enough. But what I would like to explain, and explain it very carefully, because I think I've been following the internet and other comments on this. Nobody could explain the explosive growth of the derivatives market, which has come out of nowhere. 30 years ago it was practically zero, and by now, at various estimates, it's between 600 trillion and 1 quadrillion, which is 1,000 trillion dollars strong and still growing. It's an enormous number. Just for the sake of comparison, please consider that the total amount of US dollars in the world is in the order of 1 to 1.5 trillion dollars. The US economy is in the order of between 14 and 15 trillion dollars. The world economy, actually, you can say GDP, okay? The world GDP is in the order of 40 trillion. You see? Now, 10 times that much is still not at the level of the derivatives, because we are talking at a minimum of 600 trillion. At the lower end of the estimate, this is derivatives. And 1 quadrillion at the higher end. This is just almost incomprehensible. This is so much wealth that, now, those who, nobody can explain it, but there were various people, economists, who attempted, and they said, well, never mind, this is not important. After all, there is cancellation, for every long there is a short, and you cancel, etc., etc. And they introduced the vacuous concept of notional value. Of derivatives. The suggestion is that it's just in your imagination. Well, let me tell you, it is not, because if the market goes against you, then you have to come up with hard cash to pay that. So it's not notional at all. It has teeth. You can suffer as a result. Now, in order to explain the growth of the derivatives tower, I would like to make a fundamental distinction, which I think mainstream economists fail to make. And this is the risks due to nature on the one hand, and risks due to man or created by man, including the governments. This is very fundamental because in human terms our life is a continued struggle against risks. We just have to come up with ways to control risks. Now, in one end of the spectrum, engineering is a way to control risks. For instance, when you build a high-rise building, it has a tolerance against earthquakes, but it's a certain amount which you build in. I mean, you are not going to build a high-rise structure which will withstand all possible earthquakes. That just wouldn't be reasonable because the economy wouldn't justify it. You just use some estimates historically what earthquakes, what type of earthquake, what strength of earthquakes are probably in that area, and adjust your tolerance standard accordingly. So engineering, that's just one example, there are many others. Engineering is one way to combat risk. But there is another one which is very important. These two cover pretty well the whole field. And this is speculation. Speculation as a way to control risk is very important. And you can think of speculation in agricultural commodities. Say the production of wheat, which is very important because wheat is the main staple food for so much of humanity. And there are two dangers. One is a catastrophic collapse in production, and the other could be the opposite, overproduction. If the crop fails, there'll be shortages and the consumer will suffer accordingly because prices will go ballistic. On the other hand, overproduction is not a blessing either because that will wipe out so many producers. So at the next crop cycle, there will be a punishment for that. So overproduction, which can happen, will depress prices below the marginal cost of production, and that is not only not desirable, but it's another danger. So how can humanity protect itself against these dangers? Through speculation. This is the raison d'etre for the organized commodity markets, commodity exchanges, that speculators can make bets on the probability of underproduction or overproduction, and their action will supplement supply in case of a crop failure, and will remove so much of the oversupply in case of overproduction. But what is important here to notice is that this type of risk, namely risk of overproduction or underproduction in the case of agricultural commodities, is a risk created by nature. So the speculators have to use their own intelligence to pit it against nature. So they all start with the same odds. And let the best guess win the jackpot. Now, if we turn to risks which are created by man, and I certainly include here the risks in changes of interest rate or changes of bond prices, which is the same with the opposite signature, then you will realize that this is no longer nature given. It's induced by man. The risk is artificially induced by man or by the government. Artificial, not natural. And that means a big difference if you just follow the chain of reasoning. Actually, to use the word speculation is a misnomer in the case of risks created by man, because a more appropriate term would be gambling. There's a house where the gambling takes place, and it's owned by the casino owner, and speculation takes place, but that's really gambling. And you just have to treat these two separately in order to understand the derivatives tower, which has this phenomenal increase and the danger going with it. So let me just elaborate on this. So we are talking about speculation versus gambling. Which is the same distinction as we have made between risks created by nature and risks created by man. So let me look at risks created by man. In particular, and now I'm coming to the derivatives market, in particular, consider the risks in the bond price. Under the gold standard, the bond price is so stable, in fact, so little variation is taking place that speculators will just ignore it, because there's no profit in making bets if the expected gain is too small or too slow to come about. So for that reason, there was no bond speculation under the gold standard. None. The same way as there was no foreign exchange speculation, because the foreign exchange was fixed in terms of gold units. So that created a very narrow band within which various foreign exchange rates could change. And speculators just ignored the field. They were forced to concentrate their efforts and resources on speculating in agricultural commodities where there was no alternative. There was no possibility to do anything else but make bets against odds, what type of weather or earthquake or flood and so on will influence agricultural prices. So there you have it. In the case of risks created by man, there was the need for insurance. There was also need for insurance in the other, but I'm going to discuss this after I concentrated on the first one. So let's say there was first round risk. First round risk, which is, say, the collapse of bond values. So, to meet that risk, you have first round insurance. Which is bond futures. So there is a future market in bonds, and people can go long, short, and so on. And in this way, you could insure against the risk of collapsing bond values. However, those who offer that insurance expose themselves to a new type of risk, which I will call the second round. Which I don't write it down, but it's collapse, not bond values, but bond futures, okay? That's the risk, which is separate. There's a connection, there's a correlation between bond prices and future prices, but this is not all that rigid, and in any case, in the extreme case, they could go on their separate way. So that's the risk, and therefore there is need for second round insurance. And actually there is such a thing, which is called bond options on futures. And these could be call options, put options, but for our purposes it's not important to go into the details. Let it be stated that there is such an insurance, and there's a market for that, and in this way you can control these two levels of risk. However, if you think of it, that's not the end of it, because those who are selling gold options, bond options I should say, they are exposing themselves to another type of risk, which is again a bit removed from the previous ones. So because of this new risk has arisen, there is so again, I don't write it down, but the third round risk, or third level risk, is the collapse of the bond option price. And in order to protect yourself against this risk, you need a third round of insurance. And again, there is such a thing. And this is now, just a general term, is derivatives. For each level of risk, there are people offering insurance. The problem is that rather than coming to an end to this sequence, it just continues on and on. So that goes on ad infinitum. So once the bond price is destabilized, which is the same to say that interest rates are destabilized, there a need arises for an infinite tower of insurances, because there is an infinite sequence of levels of risk. Now let's see why the same problem doesn't arise in the other case when the risk is created by nature. It is still true that there is first round risk, which is either agricultural prices going too high up in the case of collapsing crops, or too low in the case of bumper crops. And there is the first round insurance, which is buying or selling the future contract on that particular commodity. We talked about wheat, but the same way you can take basically any other commodity where the production is controlled by nature. By the way, you might ask, what about gold? Well, I have to tell you that the gold price is not a nature-made risk. It is a man-made risk, because we know very well that the gold standard means also a fixed gold price in terms of paper money. So when you remove the gold standard, you destabilize not only interest rates and bond prices, but also the gold price. And for that reason, gold future trading doesn't come under this heading. You just have to make a point that this doesn't apply to gold future. It may apply to some metals, and I'm not an expert to say that, but it could be that the production of copper has some kind of relationship to natural causes. But let's not enter this question, because that's not important for our purposes now. Now, question. Those who offer this type of insurance by buying or selling agricultural futures, are they exposing themselves to new risks? And the answer is no. The buck stops here. Because if the speculator is long in wheat future, for the sake of an example, wants to cover his risk, he will just cover his exposure. So if he was long, he will sell his contract. And it does not depend on any decision made by man. It's a decision made in heaven. It's nature created the risk. So this is a very fundamental distinction we have to make between nature created risks and man-created risks. Now let me give you an example which maybe, it's a practical example, which may be even more convincing than this. This is a bit theoretical, and you have to know a bit about futures trading, but I give you an example which is down to earth. Take something as simple as fire insurance. There are insurance companies which take over your risk. If you have a house, it could burn down, that's a risk. You pass it on to the insurer. Oh. There it is, risk. Risk of sitting down. Thank you, Derek. So, the system of fire insurance works on the assumption that there is no arson. There are no guys, or there are laws which will diminish the number of arsonists who are those guys who set fire either for its own sake or for some monetary gain, which is quite possible. For instance, if a guy can take out insurance on a house and subsequently sets the torch to the house, and then he can collect. So, assuming that society has some way of protecting itself against arson, the system of fire insurance works beautifully. You see, because the risk is nature-made. It depends on such things as lightnings and forest fires, what have you, but it doesn't depend on man. Now, compare this to a society where they don't take arson, they don't make this distinction, and arson is possible. Under such circumstances, the arsonists might find it profitable to buy insurance against fire with the thought that they are going to set things on fire and collect. You see? So immediately the risk becomes unlimited. As long as nature was the only cause of your risk, the risk was limited. And insurance against it was possible with limited resources. And most societies, advanced societies, have created such a system. But if you remove that nature limitation and allow for man in general to interfere with this, then the risks become unlimited, and therefore it's not possible to control it. Now, you see, you might say, well, what about a tower? Sure. But you see, this tower is going to grow, because as you put more and more layers of insurance on top of one another, you just keep building an infinite tower. And once confidence is shaken, this tower could just collapse. And think of the biblical story of the Tower of Babel. The people are so conceited, they said that we can build a tower as high as heaven. And then we are running the show. We take over from God. And God punished them for their conceitedness by confusing their language. The builders of the Tower of Babel were not able to communicate with one another, and the tower ultimately collapsed. They couldn't continue building it for lack of communication. So something very similar to this is happening in the bond futures market. Once the risk of variation in interest rates was removed, because the gold standard was removed, then infinite risk became a possibility, and people started building. That's us. I mean, the managers of our monetary system, our financial system, started building a Tower of Babel by adding new levels of insurance to control the ever-expanding risk. And at one point, you might have expected, or you might have inferred it from the Bible, biblical story, that this is going to bring a punishment for your conceitedness upon our head, and that tower will collapse. And that is what is happening. And I think we have reached a point where this infinite Tower of Babel, started unraveling, started vaporizing, and we just have to understand it. And as I say, mainstream economics doesn't make the distinction. In fact, I remember some famous mainstream economist, Paul Samuelson was one of them, I think he was also a Nobel Prize winner, who said that thanks heaven we have now futures market in bonds, future markets in foreign exchange, future markets in treasury bills, etc., because now people can put their money where their mouth is. If they don't like high interest rates, they can bet against it, and so on and so forth, you see, which is putting absolutely the wrong spin on this, because there's no reason to celebrate for the advent of futures markets in these financial instruments, because this was a challenge against God. You know, pretending that the risk involved in variation of interest rate, variation of bond price, is nature-made. They never bothered to look at what was the reason, the root cause of instability in interest rates and bond price. And the root cause was the destruction of the gold standard. And that's man-made. It's not nature-given. So once they removed the gold standard, then this volatility in interest rate followed, and then they pretended, so what? No problem. We just insure, as we have insured in the wheat market, or in the soybean, or whatever. That's not going to fly. And already there is proof, convincing proof, that it is unraveling. So I would like you to consider this very seriously. With compulsory modesty, I have to say that this man you are looking at is the only one who has put forward this theory. I have not seen it elsewhere. Now, perhaps if you check more carefully, you will find that other people came to that idea. But I am suggesting it to you that you have to make this distinction between nature-created risks and man-created risks, and then you will see the difference in the various possibilities of insuring against these risks. So what is this derivatives market? It is not as simple, let me just say that right away, that it's not as simple as my simplistic model suggests, that there's just one kind of man-made risk, and then, because there are all kinds of things, and I'm sure the gold future market is also part of this derivatives tower. You can't analyze it, you can't dissect it and just look at parts, because the whole thing is a jumble. It's a mixture. It's very opaque. It's not transparent at all. In fact, it's made more opaque artificially and on purpose, because that's just part of the game. They don't want you to see, or anybody other than themselves, to see what's involved and how you could separate it. Which also means additional danger, because once the thing starts unraveling, there's no way to save part of it. Just like the collapse of the World Trade Center towers, once it starts unraveling, there's no hope that half of it will somehow survive and only one side will collapse. The whole thing will come down, because of the intertwining of the various parts of it. So the derivatives tower is very complex, but if you try to understand it, you will realize that this model I've just given to you, one simple risk, which is the risk of interest rate volatility, is controlled by various levels of insurance, and this will never come to an end, because whenever you add a new level of insurance, that creates its own risk. It doesn't reflect back on the previous insurance. It's a brand new risk which will take another level of insurance, and this will keep going forever. So the derivatives market will keep increasing. Let me close with one conjecture of mine, which I'd like to put forward. I cannot be sure about that, but looking at the signs, I came to the conclusion that chances are that the collapse, the unraveling of the derivatives tower has already started, and it's well on its way. But it's being stonewalled. Now, how can I make such a conjecture? I just look at the confused action in Washington, and that goes back to the Bush administration, where Paulson was the Treasury Secretary, then Bernanke was already the chairman of the Federal Reserve Board, who still is in the same position. But the Treasury is if you analyze their acts, it was very confused, very contradictory, and sometimes you just had the feeling that these guys haven't got the foggiest idea what they are trying to do. Now, of course, they have a lot more information available to them than we have. So they have statistics which you will never be shown, and they have other signals which we are not aware of. So early on, when they started their panicky action, the facts which were available to the general public didn't seem to justify those extreme measures which they were proposing and suggesting. And people like Bush or Paulson making such extreme statements that if Congress doesn't approve this 750 billion package, then there will be disaster. This reflected that they knew that the derivatives market was unraveling. And it continued and got even more so under the Obama administration with a new treasury, new in quotation mark, because there's nothing new about Geithner. He was the president of the New York Federal Reserve Bank, very much part of the various bailout measures and so on. And this is all just one big family of bankers who are linked by common interest to save their own skin and their wealth and so on. So from our point of view, President Obama missed an historical moment when he could have made a clean sweep. He could have swept out all these guys, fired Bernanke, and never talked to any one of these guys because they were part of the problem. They will never be part of the solution. They have a different agenda, different from yours, different from society's. In fact, they are for themselves. They are not trying to protect society. So that is a conjecture, but I cannot have suggested to you that the derivative star is already in an advanced state of collapse. When it runs its full course, it's going to be very ugly. Why? Because it will wipe out all the banks, not only in the United States, but in the world. And it probably already happened, that the banks have lost all their capital, and this bailout thing is just a desperate effort to make the impression that the losses can be patched up, covered. A Band-Aid will work. It has worked up until now, so it will work in this crisis as well. But there is a big difference. When this derivative market collapses, it takes bank capital, and the numbers are so huge, these numbers, talking about 600 trillion to 1 quadrillion, which is 1,000 trillion, that there is just no way to create that much new debt. And in fact, it's already counterproductive, creating new debt. So, when the debt tower collapses, it will wipe out bank capital financial institutes, and it will also make the real economy shrink, which means production of real goods and services. And that's the danger, that's the bigger danger. Let me explain why. Because the real economy would be the only reasonable hope to salvage the situation, if it can at all be salvaged. Because the real economy is self-regenerative. Any kind, it's like a living organism. If there is a wound somewhere, nature takes care of it and the wound heals, given time and attention and so on. A little bit of luck as well. But normally you can rely on nature to do the healing for you, as long as there is real production of goods and services. But now just imagine that as the first lecture, I didn't deliver it, but I distributed the paper, the marginal productivity of debt. As this paper suggests, any new increase in debt has a negative effect on real production. Rather than helping it, it will make it contract. So they are desperately trying to increase that, hoping that they can splatter that all over the problems, and that will bring prosperity back and so on. And rather than this happening, the real economy is collapsing like a pricked balloon. And therein is the danger, because, listen to that, if the real economy is collapsing, then the revenue of the United States government is collapsing with it. Because they can no longer count on revenues from the financial sector, which is gone anyhow. But even if this is just make-believe, capital make-believe, taxes and so on. The real strength of the US government comes from revenues derived from real production of goods and services. And if that is gone, then the US government is without resources. There is no way to spend yourself into prosperity by creating new debt, new money, this and that and that. All these Keynesian recipes will fall by the wayside. That's gone, finished. There's no way of saving it. The only way would have been to stop the collapse of the real economy, and they are not doing it, they are making it worse. So that is the danger, and I'm trying to paint a picture for you which is very realistic. That is, I think, what is happening. The real economy is contracting, and that's the message of this last encore session of the Gold Standard University Live, that unfortunately we are now at the stage where the real economy is collapsing, which removes all the hope we may have had before, that there will be a recovery, there will be a natural healing process, just given time and wise management of the economy and so on. This is all gone. If there was ever any real hope for that, by now it's gone. And on this very melancholy note, I finish my lecture, and during the remaining of time we can have a discussion. Thank you.
I would just like to preempt a note here, because it occurred to me, Professor, that as Peter pointed out, we had that inverted pyramid of John Exter's, which was supposed to show that as you go into a deflationary cycle, there's an attempt to liquefy your assets and get out of assets and get into money. But in that same way, we have an inverted pyramid of our economy. We have an inverted pyramid
of debt.
Yes. And at the bottom is productivity, is a real economy. It's like a little point, okay? Yeah. And upwards of that is a growth of debt that is a result of the credit-driven that drives the economy underneath the paper system, okay? And in my mind, as I was listening to the professor, it appeared that what happened is that insurance, or as an attempt to manage risk, is always there. It's human, because you go there and you try and manage your risk to go to increase your productivity and appear the next year. Well, what happened in our paper economy is that the boys who fed the debt into the system found a way to, quote, monetize debt. They found a way to profit from the debt, like the arsonists found out, it's obvious, to found out a way to profit from fire insurance, except in this case, the arsonists were in charge of the system. And being in charge of the system, it exponentially exploded. Okay? When that thing starts to implode, it's a two-way street. There's an effect, and I really understood the purpose of your marginal utility of debt. When you talked about that, what happens is that there's a certain point in the process, and it's like heroin addiction. There's a certain point at which the addition of morphine actually makes you feel better without a consequent shakes and stuff like that. But as you proceed with the addiction, it's less and less. You need more and more to get the same feeling. You need another hit to keep you back to keep the thing going, so you can go to work the next day. And then at a certain point, you can't get out of bed. all right? Well, in the same way, it appears that what we've done here with the marginal utility of debt, as you pointed out the other day, is that when you would put
Marginal productivity.
marginal productivity of debt, that with $1 debt in, you would get $3 out the other end. You produced a, quote, positive response from debt. But
So
as
insurance works.
insurance were in the beginning. But as you progressed along the stage, it became less effective, and as the professor pointed out, it's not effective at all, it's counter-effective.
Self-destruct.
Self-destruction, yes. So what reminded me, and it just caused me off what you said, you pointed out, you said, it's going to affect government revenues, okay? Government revenues, in a sense, is a thermometer of productive capacity in the economy. Because
But it's more than that, because it plays a very positive role. It's not just a concept, it's a real force.
But government revenues is always artificial, how low or high it is. It has nothing to do with value creation. It is just shifting value created from A into B. Good government does it more or less in a proper way.
Bad government is a
just
totally
takes
negative
from the
Yeah.
deserve it to not deserve it.
I mean, think of the US military. That's not a concept, that's not abstract, it's very real.
Yeah.
It has firing power. But remove the government revenues,
collapse.
there's no more ammunition.
Yes.
But
You have the
Professor, this I
guns.
consider very good news, and that is happening. We saw it also 20 years back in Russia. So these guys will not shoot everyone on the world. So that government, as a consequence, as you explained so nicely and clearly, government revenues problem is really a good thing. Because Obama is absolutely committed to big government. It simply might not happen. Because it's simply not possible. That is one of the...
Yes, not possible, yes.
We should not be
Negative about the collapse of our
It's
economy.
a positive development. I'm absolutely sure about that.
But, you know, in that same thing, it reminded me of what happened in Japan, which is, I've always felt was a precursor of what's going to happen to us. And when the Japanese economy collapsed, which was absolutely productive, export-based in a world of where exports produce goods, as opposed to consumption, which just merely consumes it. So in a model of theoretical positive and negatives, they were a very positive model. When their economy collapsed in 1990 and entered its deflationary cycle, it continued to this day. That, and I pointed out in my talk, is that 2 years ago, the government revenues in Tokyo had decreased by 50% from 1990. 50%! That's stunning.
And that's not yesterday, that's
Yes, now, that's 2 years ago, just 2 years ago.
just to
Yeah, well, it was 50% less than in 1990. During those years, the output of Japan increased. They made more cars, they made more TVs, they made more, semiconductors. They kept more. The production increased, and we had a 50% decrease in government revenues because of the destruction that happened on that tower of debt above it. And I think this is really what we're looking at here, is that they created such a misallocation, they created such damage to the system that we don't see it, because we're all running around here trying to make things, buy things, and do things. But what they did was they fundamentally altered the structure of our financial system, where it tilted against us. And it's structural. And it has nothing to do with us. And so, I looked at this and I listened to what you said, and things fell into place. I have to say that,
let's not forget the consequences, because Switzerland and Japan has for many years now the most efficient government structures. So it's okay, the Japanese are prone to interfering in economy as much as everyone else, for sure, but due to necessity, they cannot get their fingers in all of this stuff.
yes.
A second point is...
Yeah, it's on.
A second point only, also with the banks, there are still out a huge number of banks, but small banks, which are really not at all derivatives, not even indirectly via pension funds or whatsoever. The pity now is that the big banks are kept alive, the zombies, and as long as this would be wiped out, and I'm sure the professor is absolutely right, that will be wiped out anyhow at the end of the day.
But it's so intertwined that there's no way to
The
escape.
derivatives are all in the big boys network. 99%, 9% is definitely
Big.
there. The 60
Yeah.
trillion gold derivatives is 90% plus between JP Morgan and HSBC only. I traced these numbers detailed as soon as they are published by the Bank of International Settlement. But the natural mechanism, the cure, the health mechanism is at the moment blocked. Because they should disappear. It's not a disaster. Okay, some of us had to take our accounts and go to a new, smaller bank and open it again. But now, as Jim Rogers so rightly expresses, the non-deservers, the losers, are given the assets of the one who had done a good job and should now, via a crisis, via a Schumpeter's creative destruction, to get these assets.
Yeah.
Just a comment.
True. Really.
Did I hear you right? The production, Japanese exports increased by 100%, they were going well, and yet government revenues decreased by 50%?
Yes.
So what happens when the production decreases? What happens to government revenues then? It'll go,
Even worse.
it'll disappear.
Yes, they've reached a tilting point. You're absolutely right. They reached a tilting point. What happened is the bubble of a consumption that we created in the U.S. with just unrestrained credit, it helped the Japanese float for a while. In the beginning, it helped them by exporting to the United States, which is consumption based upon just credit. And our consumption, therefore, was transferred over to China, which met, again, our consumption. And the Chinese economy started going up. So the Japanese economy, needing to expand, shifted over to China with increased production. And now both of those legs are gone.
Yeah.
Both those legs. And you can see the consequences.
A big point in that, in that is what is mentioned sometimes but often overlooked is it was the same with the US in the 30s. When Japan hit the wall, it was the biggest creditor of the world, the richest nation at that point in time. So they went into this difficult situation as very rich, and they are living from these means till today, which was the same in the 30s, in the Big Depression in America. It was the biggest creditor to the world, so that they have been sitting on cash and living out of that assets they have had so far.
Yes, your question here.
Sandra.
Yeah, Antal, you were saying earlier that the Obama administration had a chance to start with a clean table, with a clean board, and it didn't happen. And the question comes up that why? What actually happened in the background? And we may not know what happened in the background, or we may not want to know, but at the same time, I think this is a very, very important question, because if we find an answer to it, at least a partially correct answer, then it would be much easier to plot our future of where we are led by our front people. And a very similar thing is happening in Hungary on a much smaller scale.
Yeah. Well, there's a theory that the US president, whether it's Obama or Bush or Reagan, they are not free agents. There is a shadow government which is more powerful behind them. You never know. Faceless. You never know. Some people say it's the Council for Foreign Relations, and then there is this Bilderberger group, and various theories. Now, I'm not suggesting that I subscribe to this, but here is one example. Take Geithner. He's a colorless figure, he's not charismatic, there's hardly anything you can say. And then on the top of this guy cheated on his taxes, which is extremely unpopular in the United States. And with all that in public, Obama had to stick with him. He didn't even have the freedom to say, well, sorry, Tim, you're a nice guy, you have all this going for you, but you messed it up when you didn't pay your nanny tax. Too bad. So he looks up. No, he had to stick with him because this was the choice of somebody else. No, I can understand that he did not fire Ben Bernanke, because it's not so easy. It could be done, but it's not so easy. And he was already a fixture. But Tim Geithner was a brand new face.
Maybe no second one even wanted the job. I think true right now. This time it was not like Bush. We had 3 candidates with Spain, with the bank. But this time not the second one, and they have no difficulties. So they don't get important jobs filled in the treasury at the moment. That's a fact.
There's a lot of people being laid off on Wall Street.
Yeah, but even they don't want to. And this is really interesting to see.
There's a question there.
What
First,
about India and China? Are they similar risk or worse risk or
Well,
included in this?
there is one big difference. That there is real saving in China and there's real saving in India. And in India, actually, people traditionally have not believed in these omnipotent banks because their wealth is worn by their women on their body. They carry, and this is 24 karat gold jewelry which they carry. You see, the jewelry in the Western countries is 14, 18 karat, which is no good for monetary purposes. When you recycle 14 karat gold, the labor content becomes too big, so it doesn't pay. And that's not the case in India. That wealth, I mean, it's a real insurance. When you put those jewels on your wife, then that's real wealth. And it's guarded, well guarded.
American women should stand up for the financial well-being of our Western system. No more of this 14 karat. No more. They not be satisfied for the good of us all.
My wife will
So don't divorce your wife.
She wants 22.
22, see how? Yeah.
Well, let's just stay with this a little more. So even if China loses all its paper investment in American Treasury bonds, they still have the power. They have not destroyed their regenerative power of rebuilding savings, because it's there. It's people will put, and the sooner they realize that they have this advantage, and gold is the instrumentality which could put this saving into real force. China is all right. They could face a lot of problems because they built up industry too fast, and there could be a tremendous amount of unemployment, and these mobile working force could create a lot of that. I'm not saying that, but my fear is with the economy of the West, the economy of the United States, Great Britain, and Europe as well, and that's very unfortunate. And they just want to
want that production to China and
yes.
to these countries. There's no more production in the US.
Antal, if you were China, Mr. China, Dr. China, and it was your job to figure out what is the best way to take back the money that I loaned to the United States, for instance, and to other countries, what would be the best step? I think what I would do is, looking at only China's interest, is to slowly withdraw from the treasury markets and invest that money in buying up real estate in the United States, buying up factories, buying up productivity.
Well, you see, that's just the problem. The wealth of China invested in US dollar-related investments is useless. I just read it on the internet that they wanted to buy, say, a factory in Australia, and then it was overruled. Cannot sell it. Then they tried to buy real estate in the United States. It could be overruled again, and so on. If It's a big chunk, and it's not one house they want to buy. They want to buy territory which corresponds to the size of a state in the U.S. And they are not going to do that because they won't let them. So all this is now. I want to answer your question. If I had any influence in China, I would say I'm willing to write off investment in U.S. paper because it's
$1 trillion.
it's tilting, or more. It's tilting against the windmills. This is not going to be good. I mean, you might say morsels, tiny bits and pieces, but is it worth the trouble?
You don't want to go into war.
I tell you my approach. I would say China is looking pretty good as far as silver is concerned. China has been on the silver standard since time immemorial. Enormous amount of silver in monetary form exists in China. Now, most of it is hidden because people hoard it under the mattress or here or there. However, the government can bring it out if they raise the price of silver. People will start this hoarding. That's one thing. The second is, I think they are already doing that. They are trading their silver, their physical silver, in the American futures market for a real return in silver. That's again a conjecture, but I just don't believe in Ted Butler's theory of naked short positions in the silver market. I mean, I know there are occasionally naked shorts, but to say there's a permanent, a built-in, huge naked short position just doesn't make sense to me. I think it's basically covered shorts, and the silver exists in China, and China doesn't want you to know that they are trading their silver, so they just have to hire these agents who do the actual trading in the futures market. This is a conjecture, but I think it's. But I go beyond that, because China is not strong in gold. China is not strong in gold. It's per capita, it's probably among the smallest, ownership of gold, because of this simply the population. And they are very much aware of the problem that if the word gets out that they are buying gold, then the gold market will explode, and they don't want that. So I think what I would do if I had any influence in China is buy gold nevertheless. Well, sure. I mean, do all the precautions, but be aware that probably they won't be very effective, and very soon the word will get out, and then there will be an avalanche in type increase in the price of gold.
And lower the rate of loaning more money to the U.S. government.
Yeah, but that is probably the only way. And that's what really gold and silver, the only two monetary metals, no more, these two. Just like man has two legs to stand on, and that's plenty, they don't need four, but they do need the two, because one would be wobbly. So that's a kind of divine wisdom, and this is in the Bible again. The Bible talks about gold and silver, and the next metal it talks about is there are people who collect statistics, how many times the word gold occurs in the Bible, how many times silver, and then the next The next is way down. But gold and silver. So this is what we have. These two monetary metals, and that is the purpose of it, the divine purpose, the divine thought behind above human intelligence, that hoarding these metals is not a danger to society, because these metals are not really consumed, or if they are consumed, they can be easily recycled. Whereas all the other products, commodities, are really consumed. So if there is undue hoarding of copper or wheat or this or that, somebody will suffer. Or this hoarding, somebody will be hurt. But gold and silver are monetary metals, and that is the wisdom. There has to be something which is safe to hoard from the point of view of society. If you have a broad enough outlook and a realization, that you must admit that the least hurtful of all the hoarding and dishoarding that can occur in society boils down to gold and silver. So if China would follow this, then they would be, they are not in any immediate danger, and they could solve their own problem. They could be completely self-sufficient, they could remove them from the world economy if they wanted to. But they could also be the leaders. You see, if China would, and now I tell you, if I was really powerful in China, I would open the mint to gold and silver. So we invite all the monetary gold and silver in the world to come to China, be coined into panda coins or whatever, and start the blood circulation of the world economy. That's the only way.
I would predict, however, Professor, that if China did that, what you would set off is a chain opposite reaction. That somehow the Dead Sea Scrolls would be open to the public, and there would be mention throughout the Dead Sea Scrolls, not only gold and silver, but special drawing rights. It would be discovered in the ancient Talmudic texts that SDRs were mentioned over and over again. You would set this.
Thank you. Thank you, Professor, for your very clear explanation. What I heard from you really scared and alarmed me, as I was afraid to hear this. Now, you told us that this crisis will wipe away all banks. And that means a direct measure, a direct perspective for us how to act. There's no way out. We are here for gold, silver, and that was our aim to act according to. And that heard by you, sir, it's the ultimate word that I was afraid to say, afraid to hear, and that is the very important implication for our acting, our own wealth, not China or so on, that are important, yes, but on my limited, and I think other people too, limited range, that's important, how to save ourselves. So, I am really sure that it's going to happen, but what do you think it would be the symptoms of this last crash? In other words, I think there will be a limitation to international exchange.
Definitely.
According to what time?
Capital control, foreign exchange controls, all that, it will come. And actually it's a trade war, it's already on. And these competitive devaluations will come. So paper money will ultimately collapse. I'm just saying that the way I see it, and I may again be in the minority of one, that the US dollar is not leading the way down the tube. It's probably going to be the last one to go. Why? Because as other currencies, weaker currencies collapse, the US dollar will always be a kind of safe haven for hot money. And moreover, risk-free speculation in bonds will keep, that's again a conjecture, maybe I'm wrong, we'll see, but the way I see it now is that the US bond market is not going to collapse, not soon anyhow. It will be much later, because there is a risk-free speculation in US bonds. The open market operation of the Federal Reserve is an incentive, because people can preempt the Fed to buy the bond, which it has to if it wants to monetize government debt, and they pocket a risk-free profit. Another way of saying it is the bond speculators are bribed by the government to keep the game of musical chairs going. These risk-free possibilities in the bond market is the music which keeps this. So I would say, if you want to protect yourself and you want to watch for signals, we already talked about this earlier in the session. The signal is the last contango in Washington, which is permanent backwardation in silver and gold, possibly in this order, but maybe in the other order. But my bet is silver will go first. And by the way, this doesn't mean, we didn't talk about this yesterday, but it occurred to me that if there is permanent backwardation in gold and silver, this means COMEX is out of the picture. But that doesn't mean that speculation in precious metals is ruled out, because what COMEX provided was options on not gold bullion but gold futures. So once backwardation wipes out gold futures, gold options are gone too. However, options on gold bullion is still alive and kicking. So there will probably be further speculation possible in gold and silver, but that is no longer at the COMEX, but in various markets. Now, in the 1970s, there were very neat little gold option markets in Europe. One was in Switzerland, in Geneva. It was called Wolfville, and that was bought out by Swiss Credit Suisse. And then it disappeared. It was 20-year bear market in gold, so that wiped it out. But it didn't come back. I don't know why. There was another one in the Netherlands, another little gold option market. So I would say once COMEX is wiped out because of permanent backwardation, then these bullion markets will come back. So the individuals will still have a way to protect himself. But of course, these are still paper instruments.
Yeah, of course.
So you have to have a hardcore of cash gold and cash silver. Mary has been trying to get in for some time.
No, I want to put your Chinese hat back on, and you said if you were in China, that you would open the mint to gold and silver, but not put yourself in the role of the Chinese leader who's leading a communist party. And what's the likelihood that a communist country will ever go to a metallic standard?
It beats me, they have the right ideology of Marxism, which says that the US is a declining force and capitalism is gone and so on. And in spite of this, they have been accumulating this incredible, I don't think in the world history there's any comparable wealth accumulated in one hand. What the Chinese Communist government accumulated in the form of US government obligations. It's insane, especially in any case, but especially it's insane in the light of the Marxist ideology. So it beats me, I can't answer that. However, I think the Chinese people are wise, and there is an internal debate on that.
Can I just say, is it possible that they could do something similar to what Roosevelt did, we won't let the people have a gold standard necessarily, but we will do it with other countries, or we will force other countries to do it with us? Is that possible?
I guess so. That's not in my expertise, so but it sounds plausible enough.
We had Andreas, he had a question.
Okay. First of all, thanks, Professor, for your speech. It was very clear and concise.
Thank you.
And gave me a lot of insights. But I want to ask you to take the role of the devil's advocate.
China now the devil's advocate. You're in great supply. I want to act as your agent. China, the devil, we're going to get paid.
Oh, I mean the other devil. Now, let's assume the derivatives tower has come down and they have to try and build the system new. And you would be advisor, for example, for the US government or some other government in charge, powerful government who wants to build, a new fiat money system. Which advice would you give to them? Would you even say that it would be possible to try it again and start this kind of system of non-redeemable currency again? Play the devil's advocate and try to get into their shoes.
Look at me. Do I look like a guy who would suggest to any government, whether it's powerful or small, that irredeemable currency will save them? No.
Is there a possibility to build a system like this again?
Sure.
Please remember that the gold standard grew up spontaneously. Nobody invented it, nobody promoted it. There was no need to legislate that gold should be legal tender. There's no need to legislate that. Gold is accepted on its own merit without any kind of coercion on the part of governments. Whereas irredeemable currency is possible only through coercion. So if you stand back as a government and say, now let the market decide, then it will be another gold standard or another hybrid standard, meaning gold and silver, but without bimetallism, without a rigid bimetallic ratio. That is what would happen. And also with real bills, because real bills are also spontaneous. They are not there because the government legislated them. So that is what a wise government would do, step back and let the market decide. And all the government has to do is provide a mint, which will be open to gold and silver, and then people will bring their gold and silver forward because they have to eat, and thereby create employment where there was unemployment before. There will be employment because people will want to live comfortably, live in relative safety, free of various risks and dangers. So there will be a natural restart, a reset of society. And we won't have to have the hundreds of years. The gold standard took hundreds of years to blossom, but this can be compressed in a relatively few years.
I read something recently where the Chinese were supposed to have said that, that they could have replaced the dollar as the reserve currency with SDRs, from the World Bank, I don't know if that's what you were thinking about, Andrews,
I think that's what they're trying, so.
But what they suggested in public, and even that very modest proposal was shut down by Geithner, who said, no, the US dollar is sacrosanct, you can't.
But this is funnily enough, it was the second comment.
Rudy? In answer to Mary, I understand China is not the #1 gold producer mining in the world. China does not export any gold, and China recently legalized Chinese citizens to hold and trade gold.
Well, Russia as well.
Well, Russia is stronger in gold in the tradition, but I think China is already doing some of those things. And as far as this thing, to rebuild this, if this truly collapses, and people understand why it collapsed, they're going to hang them, they're going to burn them. And anybody who tries to reintroduce paper money will be a criminal and guillotined.
Exactly. It's not about electronic gold. It comes in gold and paying with the card.
If you trust what's behind it,
Trustable, you trust it.
Because gold in your pocket is gold in your pocket. Electronic gold is, in a way, a future good, like a
It
paper.
will solve the velocity of circulation problem.
Well, first it has to be accepted as being honest. And if it is honest, it's a gold standard, and it's just another way of implementing it. When there's honest gold behind paper notes, 100% gold behind a bank note, and people know it and trust it, and they can always get their gold back, it works. But when the trust starts to go away from, that's where Mises' error, if you will, comes in. He lived in an era where it was inconceivable that the government would renege on its promise, on its constitutional promise. So they're the same. And then the drift started. The trust started to fade. And suddenly the paper was the paper and the gold was the gold. And they're not the same. So I think the same with electronic gold.
Nathan?
Professor, in Australia, which was 5 months ago, if I remember correctly, at that time you said, given what you had seen in the previous 12 months, you thought that maybe there was about a year left before the dollar would have its final collapse. Have you changed your assessment? Because I know you've made reference in several of your essays to the fact that there are other tricks that the government, the Fed and the Treasury can still use that we haven't even seen yet that may prolong it. I mean, beyond the serial halving of the interest rates to reward the bond speculators. I guess it's a two-part question. Would you say that we are, therefore 7 months away from the end, or would you put a longer date on it? And which of these new tricks do you think they will pull out next to try and stop things?
I've always been very careful not to put a time frame. So I don't think I was that categorical about the 1 year. I admit that I did say that my time frame shrunk as a result of, you see, this was already at the time when the gold backwardation was looming on the horizon. And the disappearance of gold coins from coin shops, or huge premiums on gold coins over the world price of gold. So these induced me to say that the time horizon has shrunk, and probably originally I thought it was 5 to 10 years before it collapsed. Now, so many things happened since last November that indeed I have to modify my outlook, and that again, this is still subject to further modification in the future as things evolve. I would say that since these backwardations in gold and silver turned out to be temporary, I think it will, I tend to go back to my original estimate that it's several years, possibly as many as 5 years before the collapse will come. And I would see a huge resistance on the part of dollar. The dollar is not going to go smoothly. You cannot just wish it out of the system. It's going to put up a tremendous fight. And it's not just coming from the government, but it's coming from the people. People in the it's amazing, in Europe the mentality is different because they have seen hyperinflation. In the United States, there's no living memory can go back that far. So it cannot happen here. I mean, in Europe, those backward people can hold their currency and countries and economy and all that. But you see, the people have a firm belief that it's not just the government which protects them, but also God. I mean, there is a saying that. How is it? Drunkards, children and U.S. citizens are special care and charge of God. They will be protected.
You're all right.
And they believe that. They believe that.
Thank God, Antal. I was really, thank God.
So I think if the dollar drops in value, there will be speculators who come back and push it back. And if you study the life of Keynes during the German hyperinflation of 1923, he was active in foreign exchange speculation. And this may not be too widely known, but it's true because I think in Harold wrote a biography of Keynes, and it's in there, that he committed a large amount of money, not only his own money, but also he was a trustee of Cambridge or Oxford, I think it was Cambridge, but I'm not sure, and committed some official money in foreign exchange speculation. So whenever the Reichsmark, which was the currency at the time in Germany, fell in value, he stepped in on the long side and bought the currency, you see. And that was a very smart move. He always went against the market. He bought on weakness and sold on strength, which is a good approach. However, and why? There's a mathematical reason which is known as the reversal of the means, which means that statistically in these market fluctuations there is a mean, and any kind of extreme move will create a reaction restoring that means. Now this is true by and large, but there's an exception, and this is gold, because it is possible for gold that ultimately the dead cat bounce. This is what it's known. The dead cat bounce. I mean, as long as the cat is alive, it has a soft land, or more or less soft landing, and the cat bounces. But once the cat is dead, there will still be a bounce, but that will have no strength to it. And this is what Keynes miscalculated, because he went long at the last.
Yeah, one time.
And there was a dead cat bounce, but it did not last long enough for him to cover his long position, and he lost. And these were substantial losses. This is all in Harris, really. It's interesting.
What is the merit of a new currency replacing the dollar, like emerald is mentioned here and there? And, would that be the same?
Speculation. Well, you can see that the euro in many ways was a very successful thing. And by the way, the euro is the only irredeemable currency which did not originate in a default. Because the dollar, the pound, the Swiss franc, and so at one point were redeemable in gold. So there had to be a default. The government refusing to honor its solemn obligation to exchange the paper for gold. So this is like the original sin. All these paper currencies were subject to the original sin because they were defaulted. They should be. Now, the euro is an exception because the euro was created
In sin.
not as a gold redeemable currency which had to be defaulted on, but it was created as a straightforward irredeemable currency. However, the history is minimal. I mean, it was really less than 9 years, right? So we cannot say that it was a successful experiment. In fact, it's very questionable that the Germans and the Greeks see eye to eye, because the one would like to see a debasement of the euro, the other like to see it kept at the same level. And then how this will pan out, we don't know. And look at the Irish, look at Iceland, and so on. Very difficult to make predictions. My own feeling is that the euro is not as stable as it looks. It's not. And it could break up. And once the trade war starts in earnest, which means that various governments will go all out and push their exports, and the only way they know how to do it is to make their national currency cheaper, the euro will break up. Because under the present rules, they cannot use this option. But this is unnatural, and and by the way, if they listen to their prophet Keynes, he says very clearly that the national governments should be free to debase their currency. This is not only possible, but it's praiseworthy. It's a positive thing in the view of Keynesian economists. And therefore, I would say the euro is probably not as strong and stable, and it's not a real competitor to the dollar. That's my own feeling. Again, I may be wrong, but for the time being, I just have to be honest with you. And I'll be sorry if it happens, because I like, as a European and living in Europe, I like the idea of being able to cross boundaries without showing passports and changing money every time, as it used to be just a few years ago. It was a nuisance. You had to carry all these coins. Coins will never be, it's a dead waste, because the coins you couldn't exchange if you went to the other country. It's only paper money which could be exchanged, and you were cheated where you bought, you were cheated when you sold. So, as an individual, I like the euro, but I don't think it's really viable. That's my feeling in this more global situation what we have now. So let me, because time is up, let me just say this, that I'm very pessimistic, and I see that eventually the big threat is not the collapse of the value of the dollar, which will ultimately come, but before that comes, there will be a collapse in the world economy. And this is the real danger. Those who are getting prepared for hyperinflation are probably going to suffer, and suffer even more if they are speculating like Keynes speculated, because actually it's going to take longer before that happens, and it probably won't even look like a hyperinflation, because as I say, the economy will collapse before paper value. Well, in other countries, yes. In other countries with weak currencies, if the paper money will collapse in value, which means hyperinflation. But as far as the dollar is concerned, I think it is the last resort. So it will continue to be a reserve currency. It will be a refuge for a lot of people and hot money and so on, which we have. So this is my vision in a nutshell. Please also note that gold is not the only way to back a currency in a reasonable way, because government revenues, tax revenues, is another way. You see, the dollar owes a lot of its strength to the fact that the US has a very efficient way to collect taxes. The latest example of that is the arm twisting of the Swiss. The US Treasury made these Swiss banks to reveal the identity of those American investors who did not declare their deposits or income sheltered by these Swiss banks. So it's very efficient. But if the real economy, productive economy, is going to collapse, as I see it will, then that prop which the dollar has is gone, because there will be no way to collect taxes if there's no production. And if all the financial sector went up in smoke and the productive sector is collapsing, you see? So that is the danger. And I would suggest that you keep a close eye on this and watch what is happening, and that the marginal productivity of that is really negative, because the more that they issue, the more harm it does to the real economy. So that's my best advice. And of course, cash gold is absolute lifesaver or lifeboat. You just have to have it. But you also have to have silver. I tell you why. Because it will not be safe to show your gold. And certainly when you buy food, you wouldn't show gold. You show gold only if it's something major like health expenditure or something, or you are fleeing from one country to another and want to carry on your own body as much wealth as you can possibly do, then silver is useless. But as long as you are staying where you are and you want to buy food because for paper money you won't get any, then silver comes very handy. So you want to have silver, cash silver around the house, and the two of them. The gold is important, as I say, because we don't know, but it might come to that we just don't feel safe anymore in any one country, and then try to move to another, and then gold is the instrument which you want.
Professor, you
know of the immense amount of money that is being created and being thrown into an system in order to try to preserve everything. And you said, in my view correctly, that we are still quite far away from a hyperinflation.
And I'm not even sure it will be hyperinflation.
That's what I wanted to. How will that change happen, in your view, from a situation of deflation, which we are facing and which is likely to be accelerating because of lack of government revenues and of the breakdown in the economic system, and the immense amount of paper money created that probably at some point will go from just being held as such into a demand for whatever tangible assets there still are.
The tangible assets under an inflationary scenario don't play that big a role as they do on a hyperinflation, because the dollar bill, the Federal Reserve note, will be extremely strong and scarce. And those, yes, and prices will keep falling.
How would it be scarce if so much of it is being created?
Well, I'm suggesting it to you that Ben Bernanke, when he suggested that, he was boasting that we've got the printing press, deflation is not in the cards because we can always flood the economy. Watch for this. The market will start separating Federal Reserve notes according to date of issue. And the vintage issues will be hoarded. And those which have Bernanke's signature on them, the most recent ones, started with the Obama administration, can go to hell. You throw it back into circulation. So there is Gresham's law. And I'm talking about those dollar notes which have this vintage characteristic. They were issued before this flood of bailout money and the stimulation packages and all that. And even if Bernanke can flood the economy with paper money, as I say, the market has a way. By the way, this is also happening in Europe. I don't know if anyone knows. The euro banknotes have, you need a magnifying glass to find out who issued.
Yes, there is a letter in the end of the serial number.
Yeah, oh, serial number.
Yes, yes.
Okay, so
Yes.
people are separating them. Those issued by the German Bundesbank are going to be hoarded. Issued by Greece and Italy and
Pigs.
they can, this is happening.
And is there a legal base to distinguish? I mean, can you see a legal base that, for instance, the US government would say at the time, well, the notes issued by the Obama government has been in violation of I don't know what, and we consider them not legal tender, or we can...
Well, sure, the government and the central bank will say that there's no legal basis for that discrimination.
Yes.
But it's the market who has the last word. It's not the government, it's the market. And if people say, okay, before I accept this Federal Reserve note, I want to see the date on it, and reject it. You can't have that many policemen to take this man and put in a jail because he refused to accept the 2009 issued but accepted the 2006 issued. You can do that.
Professor, one more thing about that. These trillions, they're not printing them. They're electronically creating them. And they're going into the electronic pit. They don't become dollar bills. And if you remember the pyramid, The dollar bill, the actual paper dollar bill has more reality than the electronic blips. So if they create 1 trillion electronic blips that go to feed the pyramid, they don't go into circulation, they don't go into cash money. So that's perhaps part of the reason of deflation.
But even if they, let's assume for the sake of argument that Bernanke will print them. So it's not all of them, obviously, but some of them. Even that is not foolproof because of this, that the market can separate them and will separate them. So,
To be clear, Professor, that I understand it makes sense that the euro notes would be separated because the Europeans may be expecting a breakup of the euro and then it'll be by which central bank backing it. But I do find that interesting. Are you saying that that's the reason that people would separate the new Bernanke notes from the older Federal Reserve notes because they fear that the government may say, all right, these new ones were issued in violation, gross violation, and we'll repeal them, but anyone from 2006 or earlier will stay there. See, I can't understand why America would ever separate an older Federal Reserve note from a newer one. And is that the reason?
because ordinary Americans buy the Keynesian propaganda that gold is superstition. But paper money is not superstition. It's something real, which they have always been able to use to buy everything what they wanted.
So they're just applying the logic that an older one is better than the newer one when times are frightening.
No. What I'm saying is that when they get frightened that this deluge of new money is coming, they frightened only to the extent that this issue is recent. Has to do with bailouts, has to do with stimulation packages and this and that, and it's the sin of the Obama administration or Bernanke or whatever. But the dollar is basically sound, so what you have to do is get the vintage issues and hoard them. And the market letter by Carl Denninger, I think it's called Market Ticker. Or
Market
Ticker.
Market ticker or...
Yeah, Denninger suggests, he used to suggest that you should have Federal Reserve notes hoarded up to 6 months of household consumption, or maybe 12 months. See? Now, he very recently revised that and said, no, you want to hoard Federal Reserve notes up to 12 to 24 months of household consumption. In other words, you estimate how much money you will spend during the next 2 years and hoard, withdraw all your deposits from the banks and ignore the 250,000 limits, which is the insurance, the limit on deposit insurance. Ignore that because that fund, the resources of that fund, the Federal Deposit Insurance Corporation, this has been hijacked by Geithner. Because what they did is they entice the individual investor to buy the toxic debt from the bank's portfolios by extending this deposit insurance. But that's not what the deposit insurance was set up for, as a bribe money. This is ridiculous. So that is a real fraud to use them. So it's meaningless. Forget that there's this insurance. It doesn't exist anymore. You just get all the money out of the bank, the last dollar, and buy or keep in your private hoard Federal Reserve notes equivalent to these up to, say, 2 years. And then you will be safe. And I can see the logic in this argument. Now, of course, Denninger doesn't recognize gold. Or if he does, he thinks it's a poor choice, because he has an argument why he can recommend a better investment than gold. But you see, his examples will ignore various things such as portability and so on and so forth. So, okay, to make the long story short, this is what's behind the fact that paper money will be hoarded under a deflationary scenario. You can call it stupidity of people if you will, but this will not change the fact that it will happen, and it's happening.
No, it makes sense now the way you explain it. It's a psychological reaction. Once you eliminate gold and silver, people try to make sense of what's going on, and they, even though it's an irrational decision, they start to separate the older ones from the newer ones. No, it does make sense.
Yeah.
Because they're trying somehow to cope with what they're seeing. And
Yeah, but Americans can't count anymore. So they can't tell what's new or old.
We need not to worry about that, because if they really want to print these trillions, the environmentalists will be because
No.
so many trees that will not have.
No, Reinhard, in America, we're trying,
I was surprised. I have a forest, I sell trees.
well, the bell is either tolling to mark the end of the gold standard university lie, which is possible, or it's prematurely tolling to mark the end of the markets as we know them.
The king is dead.
The king is dead. Long live the king. Either way, the professor has said this session is over, though the controversy is not.
No.
And I, once again, Professor Fekete, wish to acknowledge the debt that we all feel for you dispensing your considered opinions in a time of debased opinion. And we have found that to be much more important than what we're being fed in the press. So thank you again for your time
Thank you.
and efforts. Think you can get away with no encore?
See you soon.